afternoon, and thank you for joining us for this afternoon's live call, Weathering the Coronavirus Market Downturn. My name is Darcy O'Brien, and I'm the Chief Marketing Officer at Simon Quick, and I will be moderating today's discussion. Given the increased market volatility, our Chief Investment Officer and Managing Partner, Chris Moore, and our Head of Investment Research, Wayne Yee, and I are going to host weekly market update calls for the foreseeable future until markets stabilize. Before we dive into the discussion, I have a few housekeeping items to mention. Please note that questions can be submitted through the Q&A function on Zoom. You may also submit questions by emailing me at dobrien@simonquickadvisors.com. In addition to managing our clients' investment portfolios, our advisors are looking for opportunities to implement financial planning strategies that will take advantage of the market downturn. Please keep an eye out for an email from us tomorrow, which will include the recording of today's call, as well as a piece written by our Head of Financial Planning, Bill Layler, titled 4 Financial Planning Strategies to Implement During a Market Downturn. There are some great tips in there, and so I hope you will have the opportunity to read it. For our small business owners, on March 27th, the $2 trillion stimulus package dubbed the CARES Act was signed into law. This act allocated $350 billion to help small businesses manage through this pandemic and economic downturn. These programs include a Paycheck Protection Program, SBA-backed loans, debt, and tax relief. Our advisors have been combing through the CARES Act to better understand the benefits available to small business owners, and they will be reaching out individually to clients to discuss their options. If you are a small business owner but not a client of Simon Quick, please reach out to me directly and I can help provide you with some resources. Now that I've gotten through those housekeeping items, please note the following disclaimers. This presentation is for information and discussion purposes only. Please remember that past performance may not be indicative of future results, and there is no guarantee that the concepts and ideas discussed during the presentation will be profitable or prove successful. So now I will dive into the questions. The first one comes in from Darrell, and it is a two-parter. He asks, why are you recommending we move out of international, cyclical, and small cap managers to add to quality exposure / lower beta managers right now? Isn't the quality play too late? Small cap, cyclical value, and international have been hit hardest. So why wouldn't you be recommending I add there, assuming these managers will bounce back stronger than lower beta quality exposure?
Thanks, Darcy. This is Chris. I will take that question. Our thought process there is first and foremost to hedge against future weakness in equity markets. Typically, when markets decline due to economic weakness or just a de-risking more generally, those sectors and market caps are hardest hit. It's the more cyclically oriented, the materials, the energy, the industrial sectors, or the smaller capitalization stocks that don't have the same strong balance sheets or access to capital markets that their larger competitors would. Those are generally the companies and stocks that are most hit when markets decline. And yes, that point is absolutely correct in that they are certainly the most beaten down now. And we appreciate that, certainly. We've been fortunately reducing the exposure over time and have done so even more in just the last couple of weeks. We used last week's rally in markets to reduce that exposure even further. And think that if the economy weakens worse than some are expecting, or the spread of the virus and ultimate number of deaths of the virus turn out to be worse than some are expecting, the potential for markets to decline further certainly increases. We're not at the point where we feel like it is likely that that would happen, such that we would need to be reducing equity exposure altogether. But what we're saying is, let's maintain our equity exposure, but make sure it's as high quality and defensive as it can be in preparation for the potential things may be getting worse over the next 30 to 90 days. And theoretically, should markets decline further, those higher quality, growth-oriented kind of domestic stocks would also fare better in that scenario. They wouldn't decline as much, right? So not only would the more cyclical names be most impacted, or smaller capitalization names be most impacted should things get worse in the economy and in markets. But those larger cap, higher quality domestic stocks would actually hold up better than the market, generally speaking. If you look at kind of which sectors have done well year to date, technology is one that stands out because of that. So we've shifted exposure there. I think if we were to get into a position where we felt like we've rode out the volatility, we feel like the economy is kind of going to get back on track. Maybe we've come over the curve as far as the virus goes. We could potentially see ourselves adding back that more cyclical exposure, the more value-oriented exposure. But for now, we think this is kind of the prudent way to maintain equity exposure and do so as, we've certainly seen equities decline here.
Thank you, Chris. The next question comes in from Rebecca, and she asks, how is Fiera doing in these volatile credit markets?
Sure, this is Wayne, and I'll field that one. For those who do or do not know, Fiera is one of our approved managers on the platform. The manager participates or invests in the municipal bond space. Overall, we view them as a more conservative investor in the asset class. So while we haven't seen the final marks for the month ends, we do typically see them holding in better than the broader markets. They don't capture as much of the upside when markets are rallying, but they also are more protective to the downside when markets are selling off, partly because they do retain a higher credit rating, as well as having a shorter duration than let's call it the municipal bond benchmark. So when you look at the muni bond index, it was down about 0.5% or so on the, actually a little more. It was down 0.5% yesterday, but it was down about 3.5, a little over 3.5 on the month, which was from an asset class that's meant to be somewhat like a proxy to treasuries or the Barclays Ag. It's a pretty weak number because of certain elements that we talked about probably the last week and the week prior, where in this sell-off, I think what was really dramatic about this kind of market sell-off was that it happened so suddenly. While we might have been able to see the virus spreading in China back in December, the fact that it wasn't on U.S. shores had supported overall markets. So really, it didn't really kind of come to play in the U.S. across any asset class until kind of that third week in February. And as soon as it got really serious, people looked to sell the most liquid assets first. And we made these comments earlier, and that's where you saw treasuries even lag what the fixed income markets or what the rates markets had done. And high quality assets were the ones that sold off first. And if you think about munis broadly, it tends to be held more by individuals as opposed to big institutions. So when individuals are looking to sell to raise cash, there aren't a lot of other buyers on the other side in a sharp dislocation like what we saw. So the market has recovered as the Fed implemented its different credit facilities and lending lines. So we did see that market recover into the final week and a half or so of the month, but it did lag traditional experiences. Now, we do think that the sell-off was overdone, and so do find some opportunity within munis, and we're seeing some of that kind of sell-off today as well. But so that's kind of the big characterization of munis generally, but Fiera tends to be more defensive in that vein, particularly because when you use Fiera at this stage, it has all been in managed accounts, so there's more control on what you sell and what you don't. So that has played well to the manager's favor.
Thank you, Wayne. The next question has come in from Brian, and he asks, It feels like the market is pricing in a recession. Do you agree? What are your thoughts on the possibility of a depression? And what are some things that would have to go wrong to push us into a depression?
I can take that one. I think the market has priced in a recession at this point. If you look at kind of economic forecasts, certainly second quarter GDP growth is expected to be, quite a severe contraction. Third quarter, likely a contraction, but maybe not as severe as second quarter. However, second quarter or third quarter is certainly to be determined based on the rate at which the virus spreads and deaths continue to mount, because ultimately that will dictate when the economy can get back to work. I think the markets are really trying to determine when the economy is getting back to work, and that will ultimately determine whether or not this is a recession, which is 2 quarters of negative GDP growth, or not. I think the market today is pricing in a recession. The question around a depression, that is defined as a severe recession or protracted recession, meaning more than 2 quarters. I think the possibility of that happening is very low, and I think the thought process behind that is we have taken the social distancing efforts to extremes. While painful in the short term, it should in the long term get the economy back working again. That whether or not that's 60 days or 90 days or 120 days is to be determined, but I expect it to be short enough that a depression-like scenario is really not possible. The question around what could change that is likely a function of, do we see, as some analysts have commented on, do we see the virus resurfacing in the fall, right? Is this a point at which the spread of the virus is contained, maybe sometime in late spring or early summer, and then the economy gets back to work, and the summer, everyone is back to normal activities and for the most part, and then all of a sudden we see a second wave of coronavirus spreading and more people being infected and potentially more deaths. I know the administration and a variety of private companies are working on a vaccination to prevent against that ultimately happening. But certainly in that scenario, you could experience a more severe recession, and maybe it's a kind of W-shaped recovery in the economy where you have a negative quarter or two of GDP growth, and then a positive quarter or two of GDP growth, and then another negative quarter or two of GDP growth, and then back to kind of normalization and the second wave. Whether or not we see that is to be determined. I think it's unlikely, just because of the extreme efforts that both kind of private and public entities are putting towards stopping the spread and continuing the social distancing and ultimately developing a vaccine. But we're of the view that a depression-like scenario is very unlikely.
Thank you, Chris. The next question comes in from one of our anonymous users, and they ask, why has traditional U.S. large cap value underperformed the broader market?
Yeah, I could take that one. I would say value broadly has underperformed more core-like or growth markets, and you see that to some of the comments that Chris made earlier. International markets have lagged the U.S., not even from a value or growth perspective, but just from a geographic perspective. Emerging markets equities are cheaper than U.S. stocks and have lagged as well. And I would say one of the kind of more notable factors underlying that or underpinning that is that value stocks or value industries tend to be more cyclically sensitive. And I think that's something that we have to be pretty mindful on when we construct portfolios and asset allocations. Within the value construct, you'll see much larger exposures to kind of industrials, materials, financials, an underweighting towards kind of growth industries or more defensive industries like technology or healthcare. So because of that, there's just more economic sensitivity. So in the current sell-off, it makes some sense, right? In the current sell-off, if the GDP is going to soften or from our perspective, turn negative here, the more cyclically sensitive stocks will sell off. It makes a lot of sense. I think the more interesting question here is, well, in this kind of expansionary period up until February, value stocks still lagged growth stocks. So that I think was a little bit more of a kind of an element that we try to scratch our heads and try to figure out. And I think there was a buy-in or a belief that kind of winners are kind of they're taking more market share, which drove technology to be a much meaningful part of the S&P index. Technology companies being just more high margin businesses with higher growth prospects, and a lot of that drove some of the strength behind growth stocks versus value. So I think there's kind of two different movements there, where value stocks are more sensitive to the economy, so sold off harder right now, and value stocks tend to be more older industry in certain sense, and didn't have the benefit of kind of growing with broader GDP through 2019.
Thank you, Wayne. Just a quick announcement to our folks on the line. We have 3 questions remaining in the queue right now. So if you're on the line and you have a question that you would like to have answered today, please go ahead and submit that through the Q&A function on Zoom. Or if you would like to email me, once again, that email address is dobrien@simonquickadvisors.com. And now I will dive into the next question in the queue, which comes in from Manny. And he asks, before the impact of the current COVID-19 situation and its perceived future changing impact, it was generally understood that impending market adjustment and potential election outcome expectations were embedded in the market flow at that time. How much of what we are experiencing now may still be attributed to those previously anticipated impacts and may now have also been accelerated?
I can take a crack at that one, and then Wayne can jump in if he has anything to add. If I understand the question correctly, it's the market was digesting certain outcomes pre-COVID-19, specifically around the election, and in many cases pricing those in. Is the market still pricing those in or accelerating some of those outcomes that's contributing to the decline in the market? That's how I'm interpreting the question. So if the user that posed it was asking it differently, please send us another question and make sure we answer your question correctly. I think the market right now is less focused on the election than it has been in a long time, truthfully, because I think it is laser focused on economic output and how much that's going to slow in response to this shutdown. And the market is really trying to digest the public health concerns and the economic concerns related to the spread of the virus. The election at this point, I think, has taken a back seat as far as its potential impact on the markets. I don't think the situation that we are all faced with today is accelerating any potential concerns around election outcomes. You know, the response to all of this from the administration could certainly kind of make or break this presidency's upcoming, you know, new term potentially. But I think the market is not really factoring in a change in presidency or the president staying as is come November. I think the market is really just focused on the economy and the public health risks associated with the virus.
Thank you, Chris. The next, did you have anything to add there, Wayne?
No, nothing significant, but yeah, I mean, kind of coming into February, or just kind of thinking about where we were at the end of last year. I mean, multiples were high, and people were kind of scratching their heads, how much higher can multiples go? But kind of what was really driving us into last year and the beginning of this year was kind of this reacceleration of growth as phase one of the U.S.-China trade deal kind of came into effect, and you had strong corporate earnings. So there were some other, while everyone knew, obviously everyone was thinking about what 2020 elections might look like. In that time period, there's still kind of other positive factors within the economy that were supportive of kind of equities and risk assets. And that kind of underpinned some of the strength in broader markets with the recognition that it was a very long expansionary cycle where there was the potential for kind of presidential change. And obviously everyone was going through kind of just the initial kind of primaries amongst the Democratic Party. And you saw some volatility around there. And as Biden started taking a little bit more delegates, the market was kind of pricing that in and taking some risk or kind of de-risk. It felt like there was less risk in the system versus a Sanders.
What great points, Wayne. We have a couple more questions. They've been rolling into the queue here. Our next one comes in from an anonymous caller, and they ask, for balanced investors, is now the time to be more opportunistic at these levels in the markets, or are we still in a catch-a-falling knife environment?
I could take that one. I think this is a great time to be opportunistic. You know, there are a lot of things that we are seeing at very attractive levels right now. You know, we've been allocating to distressed strategies. We've been allocating to a closed-end fund strategy that's buying closed-end funds that are trading at deep discounts. So there are plenty of ways to be opportunistic here, and I think, you know, there are going to be more ways to be opportunistic over the next 30 or 45 days, certainly.
Yeah, I wanted to kind of add on to that. We think there is significant opportunity right now across the risk spectrum. While we did go from an underweight equities to target weight equities, for clients that might not want to take that kind of risk, we're seeing an expansion of opportunities across fixed income, across credit, across shorter duration assets, across high quality structured assets, like things that have really moved out purely because of kind of market fears and kind of short-term liquidity concerns. And I think that's really kind of opened up the playing field. So I think you'll probably hear across the board that we are seeing significant opportunity across the asset class set, and it's kind of really just kind of dialing in the type of risk you want and the type of kind of what kind of return expectations you're kind of setting in over the next year or 3 or 5 years. But yeah, we're seeing a lot of ideas without having to take that view that that's a falling knife. Yeah.
Great, thank you, Wayne. I am just going through some of these questions. They are really flooding in now, so I just want to make sure I get to them all. Our next question comes in from an anonymous attendee, and they ask, can you provide some real-time sense of the liquidity or lack thereof in the bond market?
Yeah, I comment a little bit on that. The hard numbers, whoever asked the question, if you want some hard numbers, let us know, and we could, let us know who you are, and we could kind of dig up some empiric data on the back of it. Qualitatively, coming into this market, we knew that there was less liquidity overall in the system. This goes across the base, right? Like in equities, high frequency trading, the algos, a lot more computer-driven investing models. The expansion of passive investing via ETFs, like while it shows like liquidity in a bigger market, they tend to be a little bit more directional and kind of correlate together in short spurts. So even in equities, you could say, well, maybe there isn't as the same kind of two-way flow in equities. It tends to be directional flow in equities. And on the fixed income / credit side, direct lending has become a big source of kind of capital flow from the banks. The bank inventories have shrunk dramatically in terms of kind of credit risk, as well as other kind of proprietary holdings that are now in hedge fund or private vehicle hands, as opposed to market makers. And banks themselves, they've through regulation have had to take down a lot more risk. So while banks are in a much better place from a capitalization perspective, they are less able to step in and participate in market volatility and make the two-way flow that we've seen historically. So I would say that there has been over multiple years, a decline in liquidity, obviously in equities, but also across fixed income as well. And I think what we saw in March was an expression of that, where everyone moved in the same direction. In normal markets, you see two-way flow, but when there is a sudden risk-off move across the board, it doesn't matter what you owned, high quality, low quality, people just wanted to get out. So I think that is a qualitative kind of expression of how liquidity has really changed. And honestly, some of it is a little bit more thoughtful versus like in 08, where in 08, people had over-levered, took on a lot of illiquid risk, and then were forced to sell out of those illiquid positions and trying to delever in the midst of that. Today, or kind of this past month, what you saw was because hedge funds and kind of holders of more complex vehicles, they understand liquidity risk, so they look to sell what is typically liquid. And everyone sold the highest quality, most liquid stuff while retaining the less liquid stuff, and that caused another pain point that you typically wouldn't expect in a more normal trading market. So yes, to the question, there is less liquidity in the system, and I think the suddenness of the market freeze kind of expressed that. But I think this would have been expressed in to any extent in any kind of recessionary environment, to some degree.
Thanks, Wayne. We've received just a follow-up question on one of the earlier topics that was brought up by Manny, and that is, what about the thought that the market was inflated and was primed for an adjustment?
I could take that one. Yeah, we did think that the market was overpriced. We, on the back of kind of last year's run up and in the first half of the year, which continued throughout the remainder of the year, equities were on the expensive side, and we had reduced our kind of target to equities so that we were coming into this last month, we were underweight equities, and that was our rationale. We thought the volatility was historically low for the year, and valuations were stretched. And equities were certainly kind of pricing in a perfect scenario. We thought this year would experience some volatility that was normal, 10 to 15% pullback in equities. Certainly not what we've seen here. We were expecting more volatility, expecting that kind of a pullback, which is typical every 18 months in equity markets. So we, the share buybacks post 2008 were a big reason why equities rallied the way they had over the last 10 years. And quantitative easing, flushing, markets with liquidity was another reason why equities have rallied significantly over the last 10 years. So you could argue that valuations were quite stretched. I think the shock to the system that we experienced with COVID was just so dramatic and so black swan-like that it caused a very, very severe de-risking and deleveraging.
Thank you, Chris. The next question comes in from one of our anonymous attendees, and they ask, if more stimulus is offered by the administration, do you think at some point it will lose its efficacy on investor sentiment, like pushing on a string?
There is go ahead, Wayne. You can take it.
There's two parts to that, right? Because there's the fiscal side and the monetary side. And obviously we saw the monetary side work first, where you drop rates to zero. Now, that in itself is a pretty big move. But if you're going from 0 to -50, does that make any sense? Does that add any value? I do see the argument of kind of pushing against that string in kind of a situation like that. But then the credit facilities, the Fed backing more risk assets, I think that is a positive element in stabilizing the market. So I think it kind of pulls down volatility and creates liquidity for the financial system. So I think that was a positive effect. That's a little bit more complex than a headline kind of number, but I think that does create stability that is appreciated by the market, and you did see that in fixed income. The fiscal actions, I think those are real, and I think the $2 trillion package, I think, is big and material. It's 10% of the GDP, and it seems like there's going to be more to support GDP in the ensuing weeks as well. So I think it depends on how it's being expressed. And I think right now, both on the monetary side and from the fiscal side, they both were and should be impactful. And now the next question is, how do you do more? And is it an infrastructure spend? I think that can be productive, and it's beneficial long term, and it gets people back working, and kind of eases the strain on the government to backstop everything. So I think there still are some positives and ability to extract positives right now. Now, if we kept on going down this path, and if you looked at Europe and what the ECB has been trying to kind of address, like, I do think there are questions around that, but I think because we have the ability to be more aggressive from a fiscal perspective, we might not need to rely so much more heavily from a monetary perspective. But the Fed's there to backstop stuff. We're in QE Unlimited, so they're there to kind of support lots of different parts of the market, which at least should create a floor to risk.
Great.
One thing I would add.
Oh, go ahead.
I would add, if I could, Darcy. I think the new concern now, truthfully, is post 08, we had $4 trillion on the Fed's balance sheet. How do we unwind that over time? How does that eventually kind of roll off? And we started to see that in 2018, and it was, backed up last year and into this year. Now we're only adding to that balance. And I think, what I would say is it's likely that it's just going to be that much longer for which the Fed balance sheet is bloated, and those assets eventually roll off. And certainly, to Wayne's point, if we do more to stimulate, it's only going to increase the balance sheet and extend the time for which it'll take to ultimately have all of that roll off.
Thank you, Chris. To everyone on the line today, we have 2 remaining questions in the queue. So if you do have any questions you would like addressed today, please do go ahead and submit them now. Otherwise, we will go through the remaining 2 questions and wrap up. Our next question in the queue comes from Terry, and he asks, have you gotten any feedback from your managers on access to liquidity in the short term to weather this COVID-19 challenge?
Yeah, maybe I'll take that. And I guess I'll give a quick shout out to the research team to just their diligence on being on top of our managers and what's going on in their underlying portfolios. But we do actively invest in private equity, particularly in the middle market space, as well as having exposure to direct lenders and other credit-related investment strategies. And you could read the headlines, whether it's from the Financial Times or just kind of some of the larger buyout shops telling or just announcing, hey, we're telling our portfolio companies to kind of draw down their lines, pull whatever cash they can right now, because while they are not yet in breach of covenant and while they have liquidity, they might as well have the wherewithal of liquidity and the revolving lines to kind of weather through the next quarter, 2 quarters, what have you. So I think generally that is the tact that the sponsors, private equity sponsors, have been telling their portfolio companies. It might not be take 100% of what's available on your revolver. Maybe it's taking half of it or some gradient of what's available, but making sure that there is some near-term liquidity available to just be in a better position and not have to worry about making short-term payroll while people try to figure out how to kind of pivot their businesses. So now, more specifically to the question, are there challenges to accessing that liquidity? On the whole, I would say no, in the sense that if you have credit agreements in place and you have the appropriate liquidity provisions available, you are the borrower has access to that capital. Now, I think because there's a flood of capital that's trying to come in, or capital that's trying to be called down by the portfolio companies, there are conversations where the lender and the company are saying, "Hey, do you really need this cash? Do you really need this right now?" Not to say you can't have it, but don't feel like we're going to just try to not give you access tomorrow if you don't draw it today. So I do think there is a heavier level of conversation to make sure there's alignment on the borrower and the lender. But at this stage, as long as companies were within their covenant, if they're still above their covenants or their triggers, they still have generally been able to access that.
Thank you, Wayne. Our next question comes in from Michael, and he asks, do you think the market will decline further from here? Some folks that I speak to think that we will test the lows in the near future. If so, why not reduce equity exposure and go to cash?
I can take that one. It's certainly something that we think about and talk to investors quite regularly about. I would say everyone is very focused on whether or not we test the low here. And the rationale for that is the last 3 bear markets experienced kind of a peak to trough decline on average of roughly 50%. And frequently during these periods, there is a testing of a low. In this case, the last low on the S&P, I think, was around 31 or 33%. That was about a week and change ago. And, I would say more investors than not that, I speak to or have read their comments on markets are saying that we're going to test those lows. And it almost seems to me like now it's kind of become a consensus view. So, I wonder if the consensus view is in fact priced into the market. Generally, if something is consensus, it is priced into the market today. Now, we don't know whether or not we're going to test the lows or not. We certainly appreciate that things could get worse before they get better. How much the market will decline in response to that is really unknown at this point. The way we're positioning for that potential is, as I discussed before, just taking a higher quality approach. As it relates to fixed income, our exposure to treasuries and munis and investment grade corporates has increased over time. As it relates to equities, more focused on higher quality companies, those that are less likely to be impacted by recession or weaker than expected economic growth. So we think we'll likely see the markets continue to bounce around here for the time being, with days that could be 4 or 5% moves in either direction. If we do test those lows, I wouldn't be surprised if we saw further stimulus. I wouldn't be surprised if even before we tested lows we saw a phase 4 deal, or what happens if potentially the spread of the virus and the deaths from the virus come out lower than maybe some are expecting. Any of those scenarios, or a vaccine or one of the drugs that's in the works now potentially having a greater impact than expected, any of those outcomes could cause markets to move higher. So we don't want to not be invested here. We don't want to be reducing equity exposure and going to cash. Frequently, investors that have done that historically have tried to time the bottom, have missed out on some of the biggest days in markets and a lot of the appreciation in the early rally. So we want to stay invested, and would rather be kind of thoughtful about where we're invested, and then pick the right spots to be adding risk on the recovery going forward, where we're already invested, but maybe just shifting within risk profile in the equity portfolio.
Thank you, Chris. Our next question comes in from an anonymous attendee, and they ask, several months out, do you think this correction will be a boom to private equity buyout firms?
Yeah, I think this goes across the board, but if you have dry powder now, this is a great time to be investing. Now, there's the question of kind of risk tolerance and time horizon, and all that takes into effect. But yeah, this is going to be a fight it out market in kind of smaller, cyclically sensitive businesses. But those that can survive and weather through and kind of affect their operational changes, like that makes a lot of sense for them. And this will be the time for them to be able to employ that. And if you have dry powder, to be able to buying in distressed, stressed businesses, or maybe businesses that are fine, but you know what? There's less competition out there. So because of that, you can now buy businesses cheaper. Maybe incumbent management, they're fine, but they just don't want to go through another recessionary period. So you could probably buy in some attractive assets from that perspective as well. So I think with everything kind of repricing lower, obviously you have to buy correctly in the sense that you have to buy sustainable kind of long-term businesses. But the valuations around them have definitely gotten significantly cheaper and more attractive from a long-term return perspective. So yeah, buy kind of your traditional middle market buyouts, even the platform companies that are going to aggregate underlying businesses. Venture tends not to have a lot of debt. They do have a lot of spend, but if they have a good business and an adjustable market, there's still growth opportunities from that perspective. So yeah, I think buyout businesses or private, kind of private equity businesses. This is definitely a good time to be deploying into discrete assets.
Thank you, Wayne. So we are coming up on 45 minutes here, and that is all the questions we have in the queue for today. So at this time, I would like to thank everyone on the line for taking some time out of their day to participate in today's call. I'd also like to thank Chris and Wayne for sharing their insights with us. I hope that you've enjoyed today's discussion. If you have any additional questions that we were not able to address during the call, please do not hesitate to send them to me at dobrien@simonquickadvisors.com, and we would be happy to address them offline. Thank you again for joining us, and have a great evening.